Shane, how's it going?
Kyle, I'm tired, man. Had a hockey game last night. It was the 11 o'clock game, and it went into overtime. We lost in overtime with a backup goalie who doesn't play goalie very often. So it was a barn burner, though, man. We lost 9-8 in overtime. But that's my luck. The 11 o'clock game would go into overtime.
Yeah,
So I'm exhausted. How are you?
sounds like it. Doing well. Just, same as usual, kind of looking at the market. I noticed my line has held so far for, if I'm going to switch to a bull or a bear, but we got some good charts to dive into. So, without making everyone wait, today's April 27th, and let's go ahead and jump in.
Let's do it.
And so we'll go ahead and start with the chart we've shown a few times, but just highlighting the importance that you can see these bear market rallies ahead of some pretty bad stuff that comes along. '08 was one of those. So we saw Lehman Brothers file for bankruptcy, heck of a rally, and the floor fell out. So just as a cautionary warning to people that as you're getting in, you're looking at the market right now. If you feel like it ran away from you, uh, don't move too quick because certainly could change.
Yep.
And
I mean, I think that's where we are in the cycle. We're on that little upswing after, well, I don't know. You already got rid of the chart. Never mind.
yeah, and then Shane, I brought this in. This is last week's kind of market breadth indicator I like to look at. So, how are all the sectors doing in terms of being above their moving averages? And we had a lot of green. And I started thinking, hey, maybe that is a sign for time to get bullish. Now I'm going to flip it. This is this week. I had to do a double take on this one. I wanted to kind of make sure this was accurate because I saw a heck of a lot of red, and it is. This is not what I want to see. We talked about narrow leadership last time, and now we are seeing a lot of individual names start to roll over a bit here. So, any thoughts on this one?
No surprise here. Nope.
Yep. And then you brought this in. So I threw this in behind it for a reason. So I don't know if you want to talk about how the numbers are coming in now that we're into earnings season.
Not really. I don't think there's a whole lot of detail here. I think the important thing to note is that the S&P 500 for all companies, we've got 188 out of 500 companies reporting so far. And they are showing overall down 1.19% earnings. So earnings are declining. Um, and that's what I expected. I expected the S&P 500 to show, earnings lack of growth, right? So it's negative earnings growth is not growing, right? It's shrinking. So they're earning less money. Interestingly, they are actually making the driving higher revenue, but profitability has really declined, and I think it's going to keep declining as more of the 500 report earnings. And then we've got the Nasdaq 100 down below here. Only 33 out of the Nasdaq 100 have reported, and we're seeing even greater earnings deterioration. So worse profitability. Earnings are down 5.84% for the tech stocks. Um, so Microsoft was good. Looks like Meta platforms came in good yesterday. Um, but pretty much everybody else is not doing very well. Again, you see revenue growing, but profitability declining. And so that just shows you that, inflation is hitting these companies. So they're spending more in operating costs than they're able to grow revenue by, and so the profitability suffers. And that's signature recessionary behavior. We call this a profit recession. This will be the second consecutive quarter, I think, of declining earnings growth for each of these indexes, and I don't necessarily think that's over yet. Um, and so a lot of times the earnings stop deteriorating before we get to the bottom of the market. So it's possible that this will start showing improvements before the market, or the market will bottom before that. But it's just hard to say. I mean, I think underlying though, I don't want to pay more for companies that are less profitable, right? So
Right.
that's pretty much what it boils down to. I'd rather pay less for companies that are going to be less profitable, and that's what you're seeing here. So Uh,
Yep.
and
Mm,
I guess one last thing is like everybody keeps saying, oh, so and so beat earnings, beat earnings. Like all these earnings beats keep happening. Well, they're beating lowered expectations. So even though all these companies, for the most part, are beating expectations, they're still showing lower profitability. Um, so it's easy to jump over a bar that's been lowered, you know. So that's what's happening.
yep. And that was something I wanted to highlight. Is just there's a difference between beating an expectation versus just an absolute number in terms of earnings growth or revenue growth. And this is highlighting the actual decline, which I think a lot of CFOs probably were guiding their companies towards a lower number, and that's where you get those beats. So interesting to see that come in, and with market breadth where it is, uh, curious to see how the rest of this earning season shapes up, but not overly optimistic, that's for sure. And then here we are on SPY. Shane, you and I were just kind of messaging this morning about maybe me being bowled up. And, I got to say, still, just my simple way of thinking is draw a line on a chart, see if we've broken any key levels. And this orange line here that's still sitting kind of, let's just round, call it maybe that 420 level, still has not broken that. And as long as we don't close above that and really hold that, to me, looks like a sideways market technically.
Yep, I don't know. I'm not surprised to see it having pulled back from there, and I am surprised by the nice green candle today. I don't I think that's hilarious. So we'll get into how that happened a little bit later. But the market's rallying today on apparently Meta's earnings last night are more important than the horrible GDP print this morning, and so everybody wants to buy stocks. Doesn't make any sense, but that is where we're at today. So we got a little bit of a rally day going on, at least halfway through.
Yep. And then here we are going back to our, counting of the 200-day moving average. How many days is it sloping up? And here it is, 21 days working its way up. And we keep emphasizing it's not a, perfectly accurate indicator, but kind of tells you which way the trend might be going. And right now it does look like it's going up. So, what are
Yeah,
your thoughts?
no, that's it. The trend is up. There's no arguing with that. The trend is up for right now. So I think the trend can go up within the confines of a bear market. Who knows for how long? Again, technical analysis is just one input for me. It's not the primary input um, for an investment strategy. I mean, for trading, sure, technical analysis is really all that matters, I think, as far as trading goes. I don't trade on fundamental analysis, right? So when I'm buying breakouts and selling breakdowns and um, looking to do short term or swing trading, I don't really care too much about the fundamentals. In fact, just put a ticker in front of me. I don't care what the company name is. I don't care what industry they're in. I just look at the lines on the charts and I say, well, cool, I'm willing to risk this much on this trade, and that's it. I could care less. They're just tickers. I love tickers. Give me as many tickers as I can look at, and I'll look at all the charts and all the lines, and I can see how much I'm willing to risk on the fact that this line's going to go up, right? Or this line's going to go down, as the case may be. I don't care. I'll sell short. I'll go long. Whatever. As far as long-term investments and investing client money and building a portfolio, a growth strategy or something like that for longer term investing, right? So I don't mix my investing and my trading capital. First of all, it's a big mistake that a lot of people make. But for investing, technicals are what I use usually as a confirmation or as a sign of like what to do when. Um, but it has to align with the fundamental picture that I see. And technically, you know, the S&P 500 and the QQQ look great. So if you're going to trade them, like by all means, trade them. Just look at the technicals. But if you look at the fundamentals underlying these indexes, the technicals can single both all they want to, and it's going to be. Yeah, I hate to give an exact percentage, but it's only going to impact maybe 10 to 15% of my overall decision, right? The fundamentals are going to drive the other, say, 85 to 90%, and those fundamentals can easily outweigh even the best technical, you know, analysis essentially. So yeah, this is one picture. This is one thing that gets me to sort of doubt my bearishness related to the fundamentals and just say, well, the market can keep going up in the face of these horrible fundamentals for a lot longer than than you think, than anyone thinks really. Um, so anyway, yeah, technically the market's in an uptrend. I think still within the framework of an overall bear market. Like I don't think we're out of the bear market yet just because this is up for 21 days, but I do think it's interesting that it is the 200-day moving average is up for 21 consecutive days. So that's something that I guess I'll just put in the bullish bag and say, yeah, there are some things that are bullish, and this is one of them.
Hmm. Yep, and I agree with you there. And I think the best analysis you can do is when you're able to blend technical and fundamental analysis. That is a very powerful way to look at the markets. And then at the end of the day, it's really just using those trailing stops. So in this situation, if you did get bullish, got in, if you have a predefined exit, you're okay. But right now, the fundamentals still do not point towards being bullish. So you definitely want to be a little skittish. And then here's the NASDAQ, kind of the same thing here. We dipped back a little bit down into this kind of probably 312 level. We've come back up, still watching probably around 322, a break above that for that technical kind of confirmation that perhaps things are shifting a bit there. But I still think fundamentally, not seeing how the NASDAQ is something I want to be throwing a lot of money at trying to get aggressive.
No, especially with the it's weird 10-year yields going up today and Nasdaq's going up with it. Doesn't make a whole lot of sense. The optimism that I see in the markets is just it's stupefying to be honest. Like I think I know how it ends. I don't know how long it's going to take, but I think these people are crazy buying all these
Hmm.
stocks. I think it's totally insane.
Yep. And then here we are. So NASDAQ 25 days,
Yep.
clearly the trend indicator we've discussed is pointing to being bullish. And again, doesn't really line up with the fundamental story there, but it is only one observation amongst many when figuring out do you get bullish or bearish. It's just one part of that toolkit.
Yep.
And then here's Schwab. And I brought this one up specifically because I know last time we were talking about this nice rally, but talking about, hey, maybe you would want to let it come back and retest. Now is where it's starting to look a little better. If you get some of this basing in there, that looks good for that basing level. And again, confirmation and knowing that yes, this does appear to be going higher. Yep, well drawn, Shane. So right above that downtrending resistance line, breaking above that, that'd be great. But right now, the risk reward on that still looks really nice.
Yeah, I think so. I mean, even if you bought it right here, if you use this line as your risk, you're not, you're risking like what, a dollar 50 to potentially go all the way back up this way. I mean, that's a very good risk reward. And even if you use the 45 level, you're still risking, maybe 10% to make a whole lot more. So I think Schwab looks really good here. Yeah, and I don't think it's subject to all the banking issues that other financial bank stocks are because it's not a bank. It's more of a broker,
Yep,
and I just don't think that matters. So yeah, I like Schwab here.
perfect. And now let's talk about the Fed. So we can hit on some kind of macro items here, but looks like the balance sheet is unwinding again. It had a large reversal there, but trending down there. So I don't know enough to know, are we going to hit back at this lower level? I know the Fed has told us we will, but hard to draw conclusions for me on this one. What are your thoughts?
Yeah, I don't have much to say. I mean, you see that the balance sheet has kind of resumed its downturn. We'll get more data on this later today because again, this comes out on Thursdays after the bell. So we'll see what happens. But absent another bank failure, and it sounds like we'll get into an FRC chart here in a little bit, but First Republic nearly failed yesterday. I don't know, it's down like 80% or something from earnings 2 days ago, and that'll be the third bank to fail in 2 months, and that big spike is all related to the bailout of Silicon Valley Bank and Signature Bank, New York, and it was a short-lived thing. And I think the Fed is committed to reducing the overall size of its balance sheet absent those little anomalies. I still don't think that was a good idea. Um, but I'm not surprised to see it coming back down a bit. And I mean these drops are pretty substantial. Like from here to here in what's that, 1, 2, 3 weeks basically. That's pretty much the biggest 3 week move out of I don't know. It's I don't know if there's a lot like that's a lot. Like this was what from what is that, $1 trillion basically? Is that right?
Mm-hmm.
No. Is that this is 8.7 trillion, this is 8.6 trillion. So that's a
$100 billion.
$100 billion. $100 billion move from there to there, right? So this is a little bit more than $100 billion move in 3 weeks time. I don't see any other $100 billion moves in that short of a period kind of anywhere else in here, no matter where I look or draw a circle. Like that's a pretty aggressive slide. Certainly it's nowhere near as aggressive as the increase that we saw in the 1 week or 2 weeks that those banks were failing. Um, but yeah, I don't know. Definitely something worth paying attention to because as the balance sheet unwinds, so goes the market and bond markets and everything else. And so I am still I think the Fed's still committed to reducing the size of the balance sheet overall and trying to bring down inflation. We're still at 5% inflation, which is not 2% inflation. And I mean, imagine inflation still increasing at 5% on top of what it's already done. That's
Yeah,
crazy. It's just like I don't know, man. I don't know how more. I don't know how more things haven't broken and failed. But I think it's coming.
I agree. And then here's the other one. So looking at the 10-year yield, kind of basing here, looks like it wants to go higher. Again, yields don't move quite as fast as like the stock market does. So it could take time. We might just be in this range for a while, but it does look like for now, at least, we're probably going to stay in this range.
Yeah, it looks like some consolidation, um, to be expected. But wouldn't surprise me if it spikes from here.
Hmm.
I don't know about it crashing from here, but I do know that, as people see the economy slowing, they will look to go buy 10-year bonds at 3.5% because that's a pretty decent return, historically speaking, certainly as far as recent history is concerned. Um, I mean, I'd rather own a 10-year bond than, some stocks right now. So that's just me.
I'd agree. And then looking at the 2-year, kind of the same things taking place. And we've mentioned this before, but the 2 year is a little more responsive to actions that the Fed takes. So if they're hiking rates, you're going to see it more in the shorter term durations. But same thing, kind of sitting here right in between 4 and about 4.6%, which if you think about that, that's just not the way it should be. That's the yield curve being inverted. So you would definitely think if you lend somebody money for 10 years, you're going to get paid more than you would for 2 years. But that is not what's going on. And as long as that takes place, that's certainly not good.
Yeah, so the 10-year is down here at 3.55. The 2-year is here at 4. Doesn't make any sense that the 2-year is, higher than the 10-year, like you were just saying. But what's even crazier, the Fed's preferred measure is the 10s minus 3 months. And the 3 month is all the way up here at over 5%. We were buying them for clients yesterday. And part of that has to do with the debt ceiling not having been lifted yet. People are afraid that in the next 3 months, the government's not going to actually be able to pay off all of its treasuries because they need the debt limit to be raised, which is obnoxious and ridiculous. But they're probably going to raise it because they always do, because there's no way for us to make those payments if we don't raise it. And because of course the United States doesn't have any money, it's bankrupt. And we're probably not going to be able to send tax returns either without that being raised. So I I think it's pretty wild that there's that much risk in the 3 month treasury versus the 10-year treasury. But that's the way it is. So you can get 5% for 3 months, or you can get 3.5% for 10 years. I'd rather have the 3 month version.
As would I, and a lot of other people too. So, and that's what you're seeing here. So we've shown this chart, but this is the 10s minus 2s, and we hit that yield curve inversion. We've bounced off it, but it's kind of one of those indicators where once it occurs, the damage is done. So you can't undo it really. We might undo it in terms of getting back up here, but historically, you had recessionary predictor here. So in 2007, 2000, in the 80s. So it has been a pretty accurate predictor of a recession. And, if I had to pick, I would say we're probably heading that way here now, or we're already there.
Probably already there, but the funny thing is that you'll see this spread spike right into the recession. So you see it spike right here into a recession, spikes right here into a recession, spikes into a recession, spikes into a recession. This one's the back here is a little bit messier, but it did spike and spike, and then the recession came. So you're getting close to the recession when you see a spike in the spread. And so it looks like we're actually getting quite the bounce there for now. And we'll see if that precedes the recession again, like it normally does, and I would expect it to this time.
Yep. And, looking at the 3 month here, I gotta say, I'm shocked how this one, it just keeps dropping to new lows. It's insane. I don't
Yeah,
know what
what is
else
the
to
level
say.
on that now? Do you remember when you were putting that chart together? Like what was the actual level of the
Yeah, I don't know the actual number. Visually looking at this, it looks like we're at negative 1.8, which is just nuts. That means that you're getting paid almost 2% more for 3 months than you are for 10 years. Uh, Something else.
It is 1.73, the lowest in all of history. There's never been that bad ever before in recorded history. Not good. This is the Fed's preferred indicator, so they're watching this very closely, and I'm sure it's keeping them up at night because it's kind of ridiculous. So
Yeah. And this is the one thing when a chart, when I look at a chart of a stock and it's at an all-time low or something, I might think, oh, well, risk reward's good. Maybe I'll buy that. When you look at a fundamental indicator like this, where the yield curve is that inverted, there is nothing for me that says the sun's out, go out and buy all you can, get excited. This to me says, I hope they figure something out to save us, but it's bad.
yeah,
That's all
well,
I
I
can
mean,
say.
this is how banks make money, so it's again no surprise to the people here at Elevate who are paying attention to the macro picture that banks are failing. I mean, you gotta have higher long-term rates than short-term rates in order to make money as a bank. It's just how it is. But the problem is the higher that these rates go, the more upside down their balance sheet gets. It's just it's no surprise to me that banks are failing. No surprise to me that First Republic is on the verge of failing after, the two of the three largest bank failures in history already happened last month. And for some reason the market, just doesn't want to go down. It just kind of wants to go sideways or maybe even up a little bit because of course the Fed stepped in and saved the day, at least for now. So I don't know. I think it's wild, and I just won't be surprised if it all comes tumbling down.
Yep. And then here we are, mortgage rates. I think it's a little better that now we're sitting at about 6.4% or 5.7 on the 15-year. Not great, not terrible. I think we're probably going to just move sideways here for a while. Any meaningful conclusions for you, Shane?
I'll tell you what, I saw something earlier today which I thought was interesting. Uh, 3 years ago, the 30-year mortgage rate was 2.97%, so 3%. So 3 years ago, it takes us back to this area, right? This is where the 3%. This is what we're talking about right here. Since then, oh, and back then also, the average home price was $360,000 at 3% 30-year rate. So that's what was going on back in that neighborhood. Today, we're at, you know, all the way up here at 6.43%. And the average home price is 562K. Um, that's a big jump, and that's a big jump, right? So what that leads to is a $40,000 dollar increase in the down payment that you need at 20% down to buy a house. So 40,000 additional dollars in the down payment, assuming 20%. And this is the one that's crazy. Back here at 360 and 3%, your monthly mortgage payment was 1,209. Today, it's up 132% to 2,809 monthly payment to buy just the average house. So you got to come up with an extra 40 grand to put down, and you got to come up with, a lot more money every month in order to finance it. And I mean, I guess it's a good thing that the government printed 80% of all dollars in circulation over the past 3 years, which is, of course, exactly how that happened. I mean, there's nothing on the planet Earth or in the universe that is more expensive than free money. And that is a perfect illustration of it.
Yeah.
It's the most expensive thing there is. And if the government hadn't printed all that money, prices wouldn't have done what they did. And they wouldn't be telling you that inflation is transitory. Wrong. They wouldn't be telling you that, inflation won't stay high for that long. Wrong. Uh, Now they're telling you that there won't be a recession. I'm pretty sure they're going to be wrong. And then they switch to there'll be a mild recession. I bet you they'll be wrong about that too. So again, I see all this kind of stuff and I look at the stocks, not going down. They're not shooting higher or anything, but they're not going down the way that I would expect them to. And I think it's just a matter of time before it finally works itself out. Just like the first slide we showed where, in 2008, everybody was all happy and buying stocks after Bear Stearns got bailed out. And then Lehman failed and then the bottom dropped out. And so, maybe when First Republic fails, because seriously, who's going to buy First Republic Bank? Well, I guess we'll get to that slide later, but
Yep.
I think it's a house of cards, man.
It is. And yeah, I look forward to getting to that one. Right now, we'll talk about just some more high level stuff, or macro, but Shane, you brought this one in. So LEI number came in quite a bit lower.
Yeah, this is the leading economic indicator. I got the sources on there, the Bureau of Economic Analysis. So we won't spend a bunch of time on these, but it's just more evidence that investors are just ignoring crazy, obvious, and really bad warnings. Like they're just it's like going out and swimming in the ocean during a dangerous riptide, or like maybe you'll make it, but maybe you'll get sucked out to sea and nobody will ever see you again. And people just don't seem to care. But the index is now down 8% year over year, which is a level that's never not been associated with a major recession, not a mild recession, a major recession. So maybe this is the one time that it doesn't work out that way. Maybe this time it's different, as people they love to say, and get burned on. But I doubt it. I bet you this is similar as all the other times in history where this leading indicators tells you that there is a major recession on the horizon, and there's probably no. I'll tell you what, the only way to avoid it is if the Fed starts printing money, and the impact of that will be way, 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 way worse, because we just saw what happens, when they print all that money to just buying a new home. I mean, it makes it impossible. Like housing affordability is at its lowest level in maybe ever, really long time.
Hmm.
So, just one of the major indicators that investors just seem to just not care about at all. Doesn't make any sense.
Yep. And then here, little different iteration, kind of same thing.
Yeah, pretty much the same kind of idea. So this thing, it provides warning signals, but then it also provides recession signals. And every time you get the red recession signal, there's a recession that happens. And so same deal, just a different view of it. And I I think there's obviously a recession on the horizon.
Yep, I would agree with you on that one. So And then this one, the wealthy people are starting to feel it a little bit too. So, big thing, credit card companies looking at their balance sheets and their credit card write-offs. Those are some pretty telling signals of what's to come. Shane, what were your takeaways here?
Yeah, it's, I mean, pretty obvious. I don't think there's a whole lot to add there. You can just see that they are building reserves, right? They were drawing down reserves after COVID, right? They were saying, "Oh, cool, we don't need to hold as much in reserves because the government's printing enough money for everybody to pay their bills." And then they built by 410, then they built their reserves back up by 778 and 1000, and now we're way past pre-pandemic levels when the government started just printing all this money for people to pay off their credit cards, and put in their savings accounts and everything. And so, write-offs are also climbing, and this just isn't a good picture for even the wealthiest people, because not everybody can get an American Express card. They have the highest average FICO scores of any major credit card provider at American Express. So this is a good indicator of even the wealthiest Americans are slowing their spending, and American Express expects economic distress to get worse, which is why they are building all of the savings to deal with all the future write-offs that are coming. So maybe they'll be wrong, but these guys tend to have a pretty good handle on their business. They see what people are spending in real time, and so it pays to pay attention when these earnings come out.
Yep. And then Shane, you brought this in from Hedgeye, but I thought this was a great illustration of kind of the environment we're in, where you can be optimistic, things look good, but underlying there's some cracks in the, support, so to speak.
Yeah, I mean everything right here is what we're looking at. So real income and savings and consumption's going down, and capex at major companies are going down, confidence is going down, liquidity, obviously we're seeing banks fail left and right. Credit standards are tightening. These are all like signature signs of impending doom. Like, and and what did we talk about? Well, we haven't, I don't think I mentioned the GDP number yet, but you see GDP and profit growth right here begin to go down the tubes, and that is what we are seeing now. So we did look at the S&P 500 profits, which are no longer growing; they are shrinking. So that's already showing up, and we did get GDP this morning, which was not good, and I know we've got a slide for that. So yeah, this is good, a really good visual slide from our friends over at Hedgeye, and I appreciated it when I saw it, so I thought it was worth sharing with you guys.
Yeah, well, thanks for sharing that one. And then, I mean, this one on the dollar, I've heard a lot of people talking about this too, is just kind of side is the moving towards more of like a commodity-based system. So you're already seeing that in China and stuff, trying to move away from the dollar. But the US dollar certainly has lost some strength.
Oh yeah, by a lot. I mean, this is the real change. So this is like, removing the fact that the US dollar has gone up in value, right? So this is a real adjustment, and just shows that, the Chinese currency has actually gone up 3% in the reserve basket, while the US dollar has dropped 19%. And I think it's just a sign of people being fed up with the United States, thinking they can do whatever they want, print as much money as they want, export our inflation all over the globe, and like ruin emerging market economies. Like, I think people are finally tired of it. And I think people around the world are finally understanding that there's other ways to do business than in the US dollar, and you can see China really making an impact. I mean, they've already agreed to do lots of international business settled in the yuan, or non-US dollar currency. So most recently, there was some headlines about China and Brazil getting together to settle their trading contracts in non-US dollars. China's already been doing that with Russia and a whole host of other countries. So I think that's something that's likely to continue, but this is not abnormal. I mean, reserve currencies don't last forever. They tend to last for about 100 years on average, and the United States is like knocking on the door of that average. And so we're, in some respects, already on borrowed time as the world's reserve currency. And I could promise you that the moment we lose the ability to print ourselves Like right now there's a debt ceiling argument. So like we can't pay our bills unless Congress has approved to print more dollars to pay those bills. Well, what happens when countries around the world start saying, "Hey, we want you to pay us in another currency. We don't want the US dollars anymore because you guys have printed so many of them that it's like monopoly money. So we don't want that. Hey, what if they said, "Hey, we want you to pay us back in Bitcoin instead of US dollars?" And the moment the United States loses access to the printing press, it's bankrupt. Period. The only way we're able to pay any of our bills is by printing new dollars. If we couldn't do that, we would not be able to pay our bills, and the whole economy would grind to a screeching halt. And that's absolutely something that could happen in our lifetimes. I'm not saying it will, but to say that it could never happen, I think is totally wrong.
I agree.
It's
So now,
terrifying. It's
it,
literally terrifying. It really
yeah,
is.
it's a different world. So, um, now this one, so First Republic Bank we talked about, and you know what I love about this chart that we have up? It just shows you, you oftentimes, or investors think, oh, a good value buy, time to get in. It's much lower than it's ever been. I mean, right now, $5.70, $140 of upside. What could be better? Um, but as you can see, it just keeps getting beat up. And as we discussed, they're trying to avoid conservatorship from the FDIC, but now people are kind of running for the doors. So I don't know what you had to add on this one, Shane.
Well, let me ask you, Kyle. Would let's say you move to, the coast, which is where, who cares, the left coast, the right coast, doesn't matter. Um, and you need a new bank. And this is where these guys do their business in pretty, affluent neighborhoods, which is where I'm sure you'd find yourself. Would you go open a bank account at this company?
Not a chance.
There's no chance. Like nobody who, unless you've been living on a deserted island and like show up with cash to put in a bank, like there's no way that you would go to this bank. Like a quick Google search about First Republic Bank is just going to show you nothing but terrifying headlines about how this bank is going to fail. I mean, there's I would love to know how many new accounts they opened in the last quarter that weren't the 11 banks that decided to deposit 30 billion, back in March to save this. Like if JP Morgan and Bank of America and Goldman Sachs, Morgan Stanley, PNC, all these all these banks didn't put $30 billion in a month ago, this bank would have already failed. And so what you see here is that the company reported earnings a couple of days ago, and just in the past couple of days, this stock dropped from 15, right? Call it right about $15 to 5. So it's down 88% from the highs here, where the genius on CNBC said, you should buy and Karen. They said Jim and Karen say you should buy First Republic Bank. That was literally on March 14th. That is right here on this day. Stock's down 88% since then. But like literally from 15 to 5.69, this right here is 60% just in the past couple of days since they reported earnings. So when they reported earnings, obviously that 30 billion that those banks deposited a month ago didn't do much to help them out.
Hmm.
And the stock's been halted like 100 times in the past 2 days. Trading's been halted because it's been so volatile. And I just don't see any way that this bank is going to survive, because given what the news flow looks like out there, like who is going to ever go open an account? Even if it doesn't go to zero, why would it ever go back to $150 a share? I mean, if it ever goes back there, it'll probably take decades.
Yep.
More likely, more likely, what will happen is in the next couple of weeks, um, maybe even in the next couple of days, you will see one of those 11 banks that put in that $30 billion a month ago. Um, you will see them purchase First Republic Bank for something like $2 a share, which is exactly what we saw happen in 2008 with Bear Stearns, and JP Morgan bought them for $2 a share. Um, so I think this will be the next bank to fail. I'll be shocked if it doesn't. I mean, anything's possible, but I don't know, man. I can't see how their business would ever turn around. Um, the way to get the most value out of this, if you're a shareholder, is to sell it to another bank before it goes to zero, because that's probably what's coming.
Yep, I would agree on that one. So, yeah, the reputational damage does not help them with new accounts, that's for sure.
But
So,
meanwhile, everything's fine. So buy the Nasdaq.
yep,
Load up on
exactly.
Nasdaq.
And then here's our big one. So we got a GDP print, and yeah, I've got a slide after this kind of breaks down a little further, but it did drop a little bit. What were your takeaways there? It looks like a drop of 1.1%.
Well, it actually, I guess that's the economy grew actually by 1.1%, which is significantly slower than the 2.6% it grew in the prior quarter, and it was below expectations of 2%. Um, and the Atlanta's GDP Now model, all the way, like literally yesterday, the day before the print, the Atlanta Fed dropped their estimate from 2.5% to exactly 1.1%. Shocker. It's as if they had the data ahead of time, you know?
Hmm.
So I knew yesterday that this was going to miss. I mean, I was pretty sure, and I've been pretty sure the whole time. So I'm not surprised at all that GDP is slowing. But look, when you get GDP slowing, and we already saw S&P 500 profits are slowing, declining, negative actually. Like these are related, right? And as inflation drops, those companies are going to make less money because they're going to reduce prices on their things in order to move more products. But the consumer is broken. They're tapped out. They're maxed out on their credit cards. They've dwindled down their savings. Like you're going to start seeing autos get repossessed and credit cards defaulted on. And these are just telltale signs of a recession. So I won't be surprised if GDP is negative. Remember, we got two negative quarters of GDP in 2022, and everybody decided that that wasn't a recession. I think the recession started right here, and I think we are still in that recession. And I think when we look back on this a year from now, it'll be obvious that that was the case. Um, despite the jobs market being what it is, I just don't think it matters. I think the economy is slowing. I think we can see it in every single bit of data that is available to us. We can see it. And I mean, even if you just look at this longer term chart over here, you can see it's dropping. And
Yep,
it doesn't need to go all the way down here like it did in, during COVID. I'm not saying that, they're not going to shut down the global economy again. I don't think they'll ever do that again, to be honest. That was a freaking disaster. Um, but negative GDP is going to mean negative profits for all stocks. It's going to mean people lose their jobs. It's going to mean loans get defaulted on, and all the bad stuff that comes with that, including a stock market decline of probably 20% from here. That's that's probably what you'll see.
I'd agree. And then Shane, I brought this slide in here, just kind of broke that down a little more, but I was really scratching my head here. Just the personal spending number went up. And yeah, I'm not an economist, so I don't know every single input that goes into that. But what I'm thinking is, we've seen credit card balances going up. So I thought perhaps spending might be dialing back, but that's not the case here. And I don't know how this, indicates whether it's bullish or bearish, but that was just to me a surprising thing to see in there is that personal spending's up. Just wondering why.
Yeah, well, I don't think you need to be an economist. You probably know more about it than most of the economists. They just, talk out of both sides. The economists on one hand and on the other hand, they don't know anything, right? They just say stuff all the time. So, I'm not terribly surprised that the personal spending saw a tick up, just because inflation is what it is. Um, and so you got to spend more money to get the same or less stuff, and so I think that's really all it is. If you did the personal spending number in terms of like quantity of items, like number of eggs, right? Like you're probably spending more on eggs, but you're getting fewer of the eggs, right? So if you did it like by units instead of by price, I bet you it would have been down like a lot, right? So I think the only reason that this is up is because prices have gone up so much, and I think it's I think it's squeezing people way harder than anybody wants to admit who's out there buying the Nasdaq today. So that's my story. I'm not an economist either, but most economists don't know what they're talking about anyway.
I'd agree. And yeah, just something interesting to watch again, more in the light of credit card balances growing the way they are. Just thinking, hey guys, maybe take a Dave Ramsey course, maybe dial back if that's part of it. But just an interesting observation there.
Yeah.
And then pending home sales, this does not surprise me one bit. Uh,
Oh,
drop in there. So
well, we
higher
went over
rates.
we went over the numbers in the mortgage slide, right? So
Yeah.
no surprise that pending home sales decreased 23% versus the 18% expectation. And this is the long-term history. Like, we are down here in the doghouse area, and it looks like it wants to go back down. So um, none of that looks good, and that will help GDP slow down.
It will. And now for the good stuff. Babylon B. Shane, you pulled this one up, but yeah, it was a good laugh here. Chicago mayor warns that if local Walmart locations close, people will have fewer places to shoplift.
I would not want to live in Chicago, man. What a crazy thing to see. Like, I mean, how many people have been murdered in Chicago, and like you get companies like Walmart pulling out. I mean, I just I would not want to live there. I'm glad that I don't. I used to spend a lot of time in Chicago. It's a cool city, but I'm glad I don't have to go there anymore. And it's funny, I was looking back at like the CEO was saying like shoplifting is going to lead to us closing locations in certain geographic locations. But then when they closed these, they came out and specifically said shoplifting had absolutely nothing to do with it. But these guys were losing like billions of dollars, or I don't remember. Maybe not billions on these stores. I can't. It's only like 4 or 5 or 6 stores or something in Chicago, so it couldn't have been billions of dollars that they were losing. But across the board, they're losing a lot of money on shoplifting. And as people as inflation goes up and people lose their jobs, like shoplifting increases and companies have to make tough decisions. So I don't know. You can't believe anything these CEOs say. They'll spin they'll spin any story any way they want. But yeah, the Babylon Bee always does a good job of writing a headline. So this one was pretty funny.
Yep. And then Hedgeye kind of explains itself here. So good,
Yeah,
great cartoon from them.
it's a great cartoon of the bulls, just in free fall and covering their eyes to say, yeah, just click, hold your nose and buy. Everything's going to be fine. It looks better if you don't look behind at the data underlying what's going on in the economy. It all looks great. Just buy stocks.
Yep. So perfect. Well, Shane, thanks again for your time this week. Great conversation and look forward to connecting again next week and see where we're at.
All right, man. Have a good one. Thanks, Kyle.
You're welcome. Have a good one.